Now we're going to look abroad, but we want to start in the U.S. and then look from the U.S. shores out, and then we'll talk about kind of what's happening as it comes through some of the other areas. And one of the big ones that we had was a big spike in gasoline exports. So they were up 397,000, 488,000 above the 5-year average. And there's two pieces to this. One, there was a big drop down, and now you have some of that recovery. But there's also some issues when you look at what's happening in Latin America. So there is refinery work happening. So because of that, Brazil's taken down some of their refiners and has had to increase some of their imports. And if you look at what has happened between Pad 3 and Pad 1, Pad 3 has a ton of excess gasoline looking to unload it, trying to get it into the market. And again, this is where they're trying to manage that, not only just trying to manage storage, but they're also trying to manage, the fact that there is some demand down there, some of the, where are they going to make the most money? This will come down, but it'll still be elevated versus historics in general. Now, DEC, had that little bounce that we were talking about, up 85,000 barrels a day, kind of right around, still 129,000 below the 5-year average. So again, kind of within this comfort range. Propane, again, kind of holding above the 5 years, still kind of driving higher, up 79,000 barrels a day. The one that we're going to look at right now as well is oil. So oil had crude had a big drop down. It went to 2.54 million barrels a day. We thought it was going to be closer to kind of that 2.6. Instead, now we had an overshoot to that 2.9. This is where, again, that 2.628 level is kind of that comfort zone. The problem is, where are things going from here? And when we look at spreads, when we look at what is happening in just the market in general, so LLS, so Louisiana Light Sweet versus Brent, LLS is only about 20 to 25 cents cheaper than Brent. That nobody is going to take that trade because it's going to cap some of that additional export. Then you look at Dubai and WTI, which we'll have in the next slide, and that just is showing that you're going to buy Dubai versus the US 10 out of 10 times. And this is becoming a much bigger issue in general when we look at kind of what is happening, how are things flowing, where is this going to go in general? So when we look at just what is for gasoline and diesel, so 4 ships with a combined 1.2 million barrels of gasoline and diesel left Pad 3 ports for Brazil since Saturday. Small sample represents more than 300,000 barrels a day. Typical flow in 2019 is 100 to 200. So you're getting that big spike. What is pushed off, what is coming back, and that's kind of where we're sitting right now. So now when we look at the WTI Dubai spread, this is what we're talking about, and this is what we've been really highlighting since April, is that there's more and more pressure coming on just who's going to want U.S. crude, especially given where prices are versus where international flow is, because the U.S. is reflecting a price that the market just doesn't have, especially when you look abroad. So as you see these prices going up, some of these are remaining cheaper abroad. So Dubai is going to be, you're going to pick Dubai over WTI every single time at this price level. We did get some additional purchases, from India, from South Korea. I'm not saying that you won't get purchases. I'm just saying that we're not going to get the excess that we normally have, or that's going to keep us capped, which is why we have that range in terms of where we're going to be overall. Now, when we look at gasoline, we'll get that drop, but again, it's still going to remain elevated. It's still going to be strong, just because we do have that pull down into Latin America. Then when we look at distillate, as we were saying, we're going to kind of track that 5-year average, but still remain, 9-year average, but still remain below, just because we're going to be, in this gray area below that dotted line, still above the bottom, because there is some of that residual demand from not having those refiners operational, or at least cutting runs. So that's going to provide some of that support going out. Oil exports, same thing, just essentially going sideways from here, as we were highlighting before. And then propane is at that 5-year average. This is where we continue to see that demand moving up and being kind of in that middle of the road level in general. And the one thing that we're starting to see a little bit of a slowdown in is petchem, just because we had that surge. Now a little bit of calming, but Again, still an elevated amount of capacity coming through. Then when we look at Europe, so we had that big spike in product, or I should say in oil. Then we had that drop, and when you look at just the trend in general, we're still trending up. And now a VLCC is signaling Spain, so it's supposed to land June 17th after floating for the last 3 weeks, and that's where we're continuing to see some of these movements. So there's still an elevated amount of floating storage. So that floating storage is going to come on shore. And that's kind of that back and forth that we continue to see when we look at Europe, where there is capacity out there. It just so happens to be just a matter of when does it actually come down versus other. And again, these are those big things that we're talking about in general, because where's pricing? Where's demand? And when you look at the OPEC numbers, and we'll talk about this more tomorrow, we had a big increase in OPEC capacity, above kind of those expectations, where Saudi's above where it's supposed to be, not by much, but again, these are things that we continue to look at, because there's a narrative, and then there's what's actually happening. And now both of them are important for driving price. It's just one of them is where everyone is focused right now, and that's why we like to talk about both sides, because there is that difference between what is the physical market, what is the paper market, what is the forward physical market, because we're always trying to look out into, which is what we talk about in this slide. So when we look at the loading schedule is telling us what's going to happen. This is what's coming. August is going to be posted in next week, especially for Angola. And this is where we continue to see, again, those friction points, because loadings keep moving down, or for into June, and then they'll recover in July a bit. But we're not seeing prices get much better. They've gotten better. I'm not saying that they haven't, but they're not getting to where they should be, given what is believed to be this pent-up demand. And then when you look at what's been delayed, Nigeria continues to defer. That's been a problem. Now Angola is at one of the lowest loading levels that they've been at in a very long time. And when you look at it, so August loading, so despite one of the shortest programs in terms of just size of about 32, 33 cargoes, they still have 10 to 12 to sell for July. Now, again, that's the forward market. So we're going to talk about spot pricing, which is right now, but the forward market in terms of where things are going to sell, we're just not seeing those buyers show up, which speaks more to China, because a lot of that Angolan crude is going into China. While we did have India coming out and bidding on some cargoes, and they've really been avoiding some of that Middle Eastern crude, they did buy some West African. That's going to go back into motion, which is a positive in terms of absorbing some. But China remains the big bellwether, because the teapots, again, coming under pressure, that's going to become, I think, one of the bigger issues as we go forward. So Sanangol, they're down to 8 cents. So it was initially 50 cents, then it was 35 cents, then it was 25 cents. Now it's 8 cents more than dated Brent. Again, struggling to see some of that movement. Where Nigeria, some of the July loadings, they've started to get an increase. So they went from being $1 above dated Brent to $1.30. And that's where you're starting to see, and then that's for Escravos. So again, positive, because you're starting to see some of the movement. But then on the counter side, we're seeing some of that level come down and still being right at dated Brent. And it's a great issue. What do you need? What's available right now? And as we've had those deferrals, that's where we're continuing to see some of that strife back and forth, where Urals is back to the low. I shouldn't say back to the lows, but it's back to the level of $1.65 below dated Brent. Remember, it had tightened. It went from $1.95 to $1.65 to $1.45. Now it's back to $1.65. And then when we look at Trafi, they sold it for $1.95 below dated Brent. And then we continue to see some of the softness in Europe, where Brent was 15 cents below dated Brent. Fortis was 65 cents above dated Brent. But then when you look at what's being bid overall, we have it's at 45 cents end of June, 55 cents, and then for essentially into July. So a little bit of that strengthening, but again, there's kind of that flex back and forth. So there's pieces that are getting a little bit better, pieces that are getting a little bit worse. And it's just a matter of grade and buyer. And China not buying is leaving those Congo cargoes in the water, as well as Angola, which I think is the bigger concern as what happens with the teapots going forward. So then when we look at CPC blend crude, loadings are pretty much in line, a little bit lighter. But again, we've seen some of those issues with price where ESPO, as we've been talking about, the U.S. has been picking up some of those spare cargoes, which has kept prices fairly firm in general. So when we look at India total petroleum product consumption, you can see that we're actually at an all-time low, just below that 2020 pivot. Now we're starting to get some of that recovery as should be expected, as cases are getting a little bit better, people are moving around a bit more, but with some of the concerns around the variant, some of the lack of vaccines, you're going to see some normalcy. It's just not going to be this huge acceleration, which is what we saw as we went through, never really getting back to 2019 levels and then falling back off. So again, these are going to be things to watch as we go forward, because when you look at that blue line, we just never really achieved getting back above those 2019 components. And it was driven by diesel. And that's why, because gasoline did get above 2019 levels. It's just we're not seeing the drive on the industrial side, which again speaks to the economy, speaks to some of those slowdowns and pressures that we continue to see within the market. So then when we look at Fujairah, we had a bit of a draw. It doesn't offset the big build previously, but again, still positive to see some of those drawdowns, where Fujairah reported 22.335 million, which was a draw, which fell 1.35 million, or 5.7%. And the fall comes after stocks rose 16.2%, or 3.3 million barrels last week. So again, still net build, but moving things along. And it's kind of counter. It's all a matter of timing, and there have been some issues with some refiners in both Saudi Arabia and the UAE, which has limited some of the capacity in terms of putting some of this in storage, but it's also increased their exports of crude, which is why when we look at what is Saudi produced versus what is Saudi exported, you can see the exports have actually ticked back up. Now, on the light distillate side, operations, again, Saudi Arabia, UAE have been affected since late May. So that's kind of adjusted some of those movements, which as they are expected to get better, that's going to pick back up a bit. And then we did have some gasoline sales into AD and NOC. And then we did have some movements into Europe. So without the refiners active and some of those exports, that's where we got that drop. That'll start to reverse because exports are starting to slow, especially into the U.S. Staying fairly flattish into Europe, and that's again going to weigh. But then when we look at middle distillate fell 335,000 barrels. Down 8.8% as they posted a draw after rising 12.6% the previous week. And there's two sides to that. One, again, you have the refiner disruptions, but you also have a big heat wave. And if you remember, they use middle distillate for electrical generation. And when you're turning on your AC and essentially gunning it, that's going to increase some of the local demand. But then on the other side, the area individuals were talking about how the gas oil market remains well supplied, but relatively quiet as focus remains on those Chinese export quotas. So again, China is the big unknown right now, and people are waiting to see what is going to happen to the teapots in general. So when we look at stocks of heavy resid, fell 777,000 barrels, or 5.3% on the week. And they did get a little bit of a pickup, but seasonally speaking, there is normally kind of that pickup of shipping activity, so nothing kind of out of the norm in general. And then you did have those refiners that were down and are now coming back, so that helped pull some of that additional capacity out of the market. Now, crude oil on the water is back up to the 5-year average and is at the high that we haven't been at since essentially March. And there's two sides to that. One, there's a little bit more on the water in terms of storage, but we're starting to see, again, more movements of crude going back into the market as we did get, India coming back a bit, some of those movements, and then the U.S. buying more. So the U.S. has the most shipments coming to us since the first week of March 2020. So that's that, again, if you want to say things were slowing down, I'm not saying they weren't, but it was before peak COVID, before those lockdowns. So again, that's that separation where getting back to that, but we're going to bring in more oil. And even though we're bringing in more oil, and then on the other side, our prices getting, less advantageous, we're going to see exports drop, imports rise, and that'll result in some of those builds that we were talking about. And that's why when we look at oil in transit, again, right back to that 5-year average, which puts us closer to where we were in February, or I should say the end of February, beginning of March. And when you look at what normally happens, it's a counter-seasonal move, but there's been so many delays. There's been some very extensive downtime where India is actually bringing back some of their refiners a little bit harder as they come out of COVID. So they never got to the lows that they achieved, that they really went to during the first wave, which was about 60%. Instead, they stayed at about 80, 85% and right now they're getting up to 90%. So again, that's going to not only put more refined product into the market, but also put more crude in motion. Now, all of this is happening while crude oil and floating storage, again, just goes sideways. And this is the biggest concern because we're not drawing down. And when people talk about storage, they always talk about onshore storage, but never factoring in that offshore or floating storage. So that's where we continue to see this elevated level where we're just not drawing down those levels, and it's keeping things, again, fairly capped in general as we continue to see some of this elevated capacity. Now, when we look at Europe, we had some draws after having some pretty sizable builds over the last 2 weeks. We finally had some of those draws, a small one in gasoline, but a sizable one in gas oil, which again is a bit more positive. Now, that's also timing because a lot of those gas oils, that side was driven by a big surge in imports. Those are starting to get worked through, and you do have some of that recovery within Europe. So that's where, they're trying to manage that expectations. They're still not importing really anything from the U.S. They're reporting some, but not their normal, as they still have more coming from the Middle East and Asia. There is more behind it. So this is where they're, again, trying to manage it, where refiners are sticking around a little bit longer instead of being closed like they were supposed to. But this is that backdrop. Now, gasoline remains the issue because we do still have elevated amounts of gasoline exports, not to the level that we had, and we're still not seeing this drawdown normalizing, even though we do have more demand there and we do have exports coming into the U.S. So then when we look at gasoline, this is what we're talking about here, where we're moving in the seasonal direction where we typically have draws, but it's the same rate of change. So we're really not making any momentum to normal or, quote unquote normal, but we are moving in a seasonal direction. And that's where we continue to see some of this back and forth in terms of where things are going. And then fuel oil, they're still trying to recrack. They're still, again, creating that gasoline. So turning the fuel oil into a lighter product through recracking, and that's keeping that gasoline side. So they still have a lot of fuel oil to work through, which will keep their net oil demand a bit diminished versus normal, which is why we're seeing some of that pressure in Urals as well as light sweet crude coming from the U.S. Now, on the Singapore side, as we talked about, we had that drop, and then we were expecting this big spike. We got the spike, and now, as we were saying last week, we're just going to go sideways. And here we are just kind of going sideways, really not any movement up or down. It's just going to be this competition because we do have those exports, but we do have some of the refiners coming back. COVID's still causing an issue in Southeast Asia. So losing some of that, residual demand, and that's where you continue to see storage moving higher in the area, even though you have exports picking up as well. Now, on the middle distillate side, remember we did have some of those flows. A lot of this left to go to Europe. It is still in transit, and we still haven't had those exports from China. India is still increasing, so this is going to remain kind of at this 15-year level. Really not much to say up or down. We think that this one's just going to go sideways for the most part. Now on the gasoline side, this is where it's moving closer to, seasonally we have a draw. This is where we think this is going to go back up, but not up to where it was in the beginning of May, but just really kind of up to sideways, like kind of that little slant to the upside. But the one that continues to build up is resid, where resid was, had a build to 26.9. And that's going to get recracked, and that's where we continue to see this recracking activity, which is why we talk about light distillate, because that's going to turn into that light disty, which is where they continue to kind of play with and try to manage those movements. So then when we look at the time spread, things have continued to improve. They're not where they were in Feb, but again, getting better, pointing to that near-term strength. The issue that I always continue to have, and no one can really explain it in a way that I guess makes a lot of sense, is if everyone is expecting higher prices, well, and this is for someone who was buying and selling this, people were buying $120 oil to sell it at $150. So even though we had these elevated prices, you were still in contango, and now we're in pretty steep backwardation, but shouldn't it be a little bit either flatter or at least, into some sort of contango if there's a view that the next few months are going to be stronger? And that's where we continue to see some of this friction, because some of the data is like, okay, this is pretty bullish. And then you look at it, it's like, well, but why is that happening? Like, where is the deviation that we're seeing in terms of some of those underlying cost components? And then when you look at just, again, that spread between WTI and Brent, that's where it's widened out, which is why we see that pressure. And that's where WTI is going to underperform versus Brent, just given some of this hindrance on movements because of the elevated price underlying it. Then when we look at margins, refinery margins continue to be on this kind of downward trend. They're flatlined a bit, but at Brent prices where they are versus differentials, refiners are struggling just given what's in storage, and then versus what they can buy and produce in the Singapore level, which is why we continue to see it remain very depressed. And it's also the reason why they're looking to get creative, use more fuel oil, use more gas oil to try to adjust some of those flows in general. Then when we look at Urals, same thing, where there's really not much to say one way or the other. Europe is in a reopening stage that is pulling some more through, and it's just a matter of trying to play with the blends as we've had some of that rollover in terms of margin. And then you can see that divergence. And this is playing out in a lot of places, which is why crude grades, especially in the physical market, are trading at such vast, where some of these numbers, you point to that and you say, well, that's pretty bearish. And then some of them are on the bullish side. And it's because of this blend split that we continue to see, where some of the products just don't have that demand that they should, and others have some that really are more abnormal, but you can see more and more trading at that negative level. But the one that remains is that hydrocracking, because that suite of products as gas oil, especially in the Mediterranean, remains fairly strong. Now, super tankers into China, remain flattish, and this is what is giving some pause in the physical market, because teapots are one of the big reasons why we're not seeing more of these cargoes flagged for China. And this is why we talk about Asia as much as we do, because India is starting to pick back up. We saw them bid for some decent cargoes, but we're just not really seeing some of that full normalcy in general, which is obviously China, the largest importer of crude. So then when we look at runs, so some of the runs have picked back up, and this is why we talk about those teapots or the Shandong ones, where we did have that little tick up to 68.1%. It's just, it's going to be difficult for them to continue to operate given the unknown, or what has been perceived to be cheating on the import side. So when you think about that cheating, we'll talk about in a minute how much crude is in their storage tanks, because there is a chance that the storage that is reported is actually under where they actually are, and we'll talk about some of the implications to that. So here's Asia continuing to remain elevated, shifting higher again, staying within this kind of tight range. of about 6.5 to about 8 million. 80 million barrels. 6.5, 65 million to 80 million barrels of storage, and you can just see how elevated that is versus historics. North Sea, a big spike up. Again, this is that timing delay, which is why when we look at Europe, and we look at crude in transit, this is where, Brent, some of that pipeline work should be finished by another next 5 days. That'll bring some more back, starting to fill up. And again, this is going to be what gets imported into the European tanks, what gets sent into Asia. And we're starting to see some of the prices get a little bit weaker to try to incentivize some of that buying. But India's not buying and China hasn't shown up. And again, this is going to put some of that additional into floating storage and push much closer to that 5-year average. Now, West Africa, we did get some additional movements. It's following that 5-year average. India did pick up some more, so that will help kind of offset. But Angola still has cargoes to sell, which is going to keep us fairly balanced. Now, we think that will be above the 5-year average, but again, not as extreme as we were, because we do have some additional movements into India, but then that's going to turn into floating storage in Asia. So it's just a matter of what side of the balance sheet you're on. And then when we look at Middle East, it continues to trend up, still above the 2020 level. We never really got back down to normal. And this is where we continue to see some of these pressure points in general in terms of where things have come to pass, where there's just more. So now demand has remained fairly stable for Middle Eastern crude. It's just there's more supply coming. And now Iraq, they reported about 3.8 million, and then the actual number was about 3.9. So again, this friction point as to what's reported and what is actual continues to be an issue within OPEC. Europe, the timing delay in terms of where things are, increase in floating storage, decrease in onshore. This will flip, and then we'll, just given where movements are and cost, as they continue to bring prices down to try to move some barrels, this is just going to keep this elevated in general. Now, when we look at China and Shandong, when we look at 2021, still, seasonally all-time highs, moving back to 2021 highs. But given the commentary and the investigation, it really looks like these are remaining elevated and could be even higher than this is showing, which again just speaks to why there could be some of these issues in terms of just timing and it just in terms of what is going to go or what is they're purchasing. And if they don't show up, then that's going to leave a decent amount of crude in the market, specifically West Africa and Middle Eastern capacity, as fuel oil stocks remain at 2021 highs and seasonally adjusted over the last 5 years, all-time highs, which is going to be difficult, especially when the levies are going to kick off next week in terms of the additional costs. And there's going to be some of those unknowns as we look at what happens with China. As the Iranian, there was a sanction lifted, crude fell and now it came back because it was only on one person and it was a former oil executive. So again, but there is that concern about Iran. And one last thing about the Iranian side is, as they come back, they produce a lot of condensate as well, which goes into China, which goes into South Korea. And as they bring back crude and increase production, that's going to put more condensate on the water, and that's going to displace even more some of our U.S. light sweet. And again, that'll put additional pressure on just our exports and pricing underlying it. So that's all we have for today. Sorry it's coming a little late, but hopefully it's helpful. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.